Welcome to PhillipCapital Weekly Market Watch. I'm Lin Sin from Unit Trust Research. Today, we will be looking into how Singapore has fared amid external and domestic headwinds. Singapore's economic growth moderated slightly to 5.1% on year in the quarter ended March, from 5.5% in the previous quarter. The goods producing industries, i.e., manufacturing and construction sectors, gained momentum, driven by stronger expansion in public sector construction activities, while services producing industries grew at a slower pace. Singapore's manufacturing activities continue to gain traction in April, as the Singapore's Purchasing Managers Index (PMI) stayed above in expansion terrain for 4 straight months amid lethargic external environment. The PMI has reached its highest level in 7 months at 51.1, up from 50.8 in March, as manufacturers reported more new domestic and export orders, as well as growth in production and inventory. PMIs of key export markets, example given China, US, Europe, have also generally indicated expansionary, albeit easing marginally in recent months, will lend support to the trade-reliant economy. With the US labour market recovery expected to continue, and the Eurozone showing signs of emergence from recession, offsetting China's slowing growth, trade-related sectors should grow at a moderate pace. Exports extended its upward trend and continue to outpace imports, a sign that the economy is recovering after exports fell 10 months out of the year in 2013. Meanwhile, domestic-oriented activities are expected to remain resilient, supported by construction of transportation, housing, and social infrastructure. However, the domestic manpower crunch and escalating business costs are set to erode performances of several sectors, which are more tied to the local resources, in particular the services sector and the SMEs in the coming months. Monetary Authority of Singapore (MAS) is expected to stand pat on its exchange rate policy of gradual appreciation of the Sing dollar. Inflation is expected to pick up in the coming months due to wage pressures and firms to pass on accumulated cost increases to consumer prices. Nevertheless, according to MAS and the Ministry of Trade and Industry Singapore (MTI), imported inflation is expected to remain generally subdued as a result of spare production capacity in the advanced economies and ample supply buffers in the commodity markets. Hence, core inflation is expected to rise over the next few quarters and average to 2 to 3% in this year. To get inflation expectation anchored and hence lead to a more sustainable medium-term and healthy pace of economic growth, MAS has slightly revised downward its 2014 headline inflation forecast to 1.5 to 2.5% from the range of 2 to 3% previously, amid tightening bias on monetary policy. In light of the above, Singapore has tried to adapt and reposition itself. 1. By expanding overseas. Expanding overseas is a necessity for Singapore companies grappling with rising rental costs and a labour shortage at home amid a government clampdown on foreign workers. Firms will have to restructure their businesses by improving productivity, reconfiguring their businesses, or entering new markets. In addition, domestic market is small in Singapore. Local businesses would always look forward to seek opportunities overseas. 2. Structural reforms to improve economic productivity while maintain strong domestic demand. For example, the Quality Growth Program, which includes tightening migrant worker policies, a 3-year wage credit scheme for job retraining, and incentives for new growth industries targeting the services sector, investments in technology research and development, and further positioning Singapore as a financial center in the region. 3. Positioning as Asia-Pacific region's infrastructure hub to capitalize on the 10 trillion Sing dollar need for infrastructure investments as the region marches towards economic growth and urbanization. This will create opportunities for local companies stretching from banks to construction firms to play a part across the entire value chain, including design, construction, operation, management, as well as finance, in projects ranging from transport, power, water, and telecommunications. 4. Joining Trans-Pacific Partnership. US is facing headwinds, in particular from Japan and Malaysia, to finalize on the deal. However, if finalized, it will be a gateway for Singapore to access the multilateral free trade between the other 11 members, which the 12 countries together contribute 40% of the world's GDP and account for 1/3 of its trade. 5. Initiative on Regional Fund Scheme, which may lead to a potential rise in the foreign direct investment. The initiatives include 6 economies in the Asia-Pacific region, namely Singapore, Australia, Korea, New Zealand, the Philippines, and Thailand. The proposed Asia Region Fund Passport will allow fund managers operating in one of the member economies to offer their funds in other member economies under a streamlined authorization process, and is still in the midst of discussion. If successful, the passport scheme will promote funds inflow. To sum up, growth is expected to stay on a broad upward trajectory, but capped by supply constraints, particularly in the labour market. The Singapore economy is projected to expand by 2 to 4% this year, with the unemployment rate likely to remain low amid tight labour market. Let's move on to equity market. The Straits Times Index remains resilient despite US correction, which was pulled by technological stocks. Earnings season is starting to kick in. We see higher gains from cyclical stocks, in particular property stocks, financial shares, and plantations, which buoyed STI. We see any significant profit taking as an opportunity to accumulate. We also see fair valuation of STI relative to the US market. STI sees a consensus earnings forecast growth to contract slightly at 0.75% year-on-year, which translates to a forward 14.19 times PE. However, it is less stretched relative to the US market, which have valid for 5 years, trading at around 17 times earnings. Hence, we think that forward PE remains attractive despite earnings expected to be pressured by local constraints. Therefore, we maintain our stance to overweight on Singapore. With that, I've come to the end of the presentation. Thank you for watching this week's Market Watch. I'm Lin Sin from Phillip Unit Trust. Tune in for more Market Watch videos.